This question will walk through lessor and lessee accounting. The following facts are for a non-cancelable lease agreement between Hebert Corporation and Russell Corporation, a lessee. The inception date is July 1st, 2020. The annual lease payment due at the beginning of each year, starting July 1st, 2020, is $20,066.26. The bargain purchase option at the end of the lease term, reasonably certain to be exercised by Russell, is $4,500. The lease term is 5 years. The economic life of the leased equipment is 10 years. The lessor's cost is $60,000. The fair value of the asset at July 1st, 2020 is $88,000. The lessor's implicit rate is 9%. The lessee's incremental borrowing rate is also 9%. And we're also told the collectability of the lease payments is reasonably predictable, and there are no important uncertainties about costs that have not been incurred by the lessor. The lessee assumes responsibility for all executory costs. Both Russell and Hebert use IFRS 16. And so we're told to calculate the amount of the right of use asset and lease liability. So this is okay. So this is from the perspective of the lessee. So we are Russell, the lessee. So what is our right of use asset and our lease liability? So of course, the first thing we need to do is to calculate the present value of the lease payments. So we need our begin mode on because we're told that the payments are due at the beginning of each period. So up here it says annual lease payment due at the beginning of each year. However, the year is July 1st, which we'll talk about. So we're going to have N is 5. Our I is 9. So it's 5 years, 9% interest. And the payment, which we're already told in the question, is going to be a cash outflow. So it's going to be negative 20,066.26. And the future value is going to be, now up here it says that there is a bargain purchase option at the end of the lease term, reasonably certain to be exercised by us, the lessee, $4,500. So because it's reasonably certain to be exercised, we're going to include this as a cash outflow at the end of the lease. So then we're going to put compute present value, and we will obtain $88,000. Okay, so our right of use asset. So our right of use asset and our lease liability is $88,000. Discuss the nature of this lease to Russell Corporation, the lessee. So from a lessee perspective, IFRS, so is it low value? No. The lease payments are $20,000. And is it short term? No, it's 5 years. So therefore, this is it is a right of use lease. That's as simple as it gets from the lessee's perspective for IFRS. C says, discuss the nature of this lease to Hebert Corporation, the lessor. So from the lessor's perspective, under IFRS, so we need to figure out if one of the following criteria are met. We've got transfer of title. We've got, and I'm using these bright line tests from ASPE, but we can use them as a guideline under IFRS as well. So is the lease term greater than 75% of the asset's economic life? And is the present value of the lease payments greater than 90% of the asset's fair market value? So let's see what we've meant here. Well, there is a transfer of title, yes, because we know from up here that there is a bargain purchase option that is expected to be exercised for $4,500. Let's check on the lease term. So the lease term is 5 years. And where's the economic? The economic life of the equipment is 10 years. So we've got 5 over 10. So this is only 50%. So this one is not met. And the present value of the lease payments, which we calculated here, is $88,000. What's the fair market value of the equipment? The fair value of the asset is also $88,000. So we've got, that's 100%. Our minimum lease payments, our present value is $88,000. We're also told that the fair market value of the equipment is $88,000. So this is 100%. So this is net. So therefore, this is a capital lease. We also have to assess the revenue recognition criteria under ASPE, which would be whether collectability is reasonable or there's any additional payments that the lessor can't estimate. And right here, we're told that the collectability is predictable and there are no important uncertainties about costs. So we know that those are not going to be an issue. So we know that it's going to be a capital lease. So now what type of capital lease is it? Well, the fair market, the lessor's cost of the equipment lessor's cost of the equipment was $60,000 and the fair value of the asset is $88,000. So we've got the lessor's cost of the equipment was $60,000 and the fair market value of the equipment is $88,000. So there is profit on the equipment. There's profit on the equipment, which is the difference between these two things. So therefore, this is a manufacturer deal. This is a manufacturer. Therefore, this is a manufacturer or dealer lease under IFRS. And that's because the lessor's cost was only $60,000, but the fair market value was $88,000, which is what it says right in the question. So we know these two things are not equal. If the lessor had to pay $88,000 and the equipment cost $88,000, then we know we would have a finance lease. But because there's profit happening on the equipment, then we have a manufacturer dealer lease. All right, let's take a look up here. Then we've got prepare a lease amortization schedule for the lease obligation for Russell Corporation. So now we're back in the perspective of the lessee, and we need an amortization schedule for the 5-year term of the loan. So we're going to have the date, we're going to have the annual payment plus the bargain purchase option. We're going to have the interest expense. We're going to have the reduction of the lease liability, and then we're going to have the carrying value of the lease liability. So let me just expand these columns so we can see what's going on here. Okay, so let's put our dates down here. So the lease was signed July 1st, 2020. And so we're going to put this date down first, as we always do. Then we're going to have July 1st, 2021, July 1st, 2022, July 1st, 2023, July 1st, 2024, July 1st, 2025, or June 30th, say June 30th, 2025, which is when the lease expires. So our carrying value of our lease liability is going to start out with this present value that we calculated, which is $88,000. Okay, and then we're going to have our annual payment here, of course, excluding executory costs, which is going to be $20,066.26. And this payment is going to be for these years here. And then in the end, we're going to have this bargain purchase option that's likely to be exercised. And because it's likely to be exercised, we're going to include it for the lessee. Now, interest expense on the first date, it's really important that we remember, is always 0 because this is on day 1. We can't accrue interest expense yet. So we're going to have this minus the interest expense. And then this carrying value is going to be reduced by the reduction of the lease liability. Okay, and then here is going to be the carrying value times the interest rate, which is, the interest rate is 9%. So now because we're in Excel, we can just drag these formulas down. Great. And we can see that it's working properly because the lease carrying value at the end of the lease is 0. Okay, so let's record our journal entry on the inception of the lease. On inception of the lease. So we're going to have debit, right of use asset, and it's going to be $88,000. We're going to have credit cash, and this is going to be our first lease payment right here. And then we're going to have credit lease liability, and it's going to reduce it by this payment minus the cash, which is the $67,934 that we can see in our amortization schedule right here. Okay, so then now we're asked to do in the question, we did the amortization. Now we're asked to prepare the journal entries to reflect the signing of the lease agreement and to record the payments and expenses related to this lease for the years 2020 and 2021. So for 2020, December 31st, adjusting journal entries. Now, normally we would always have 2 adjusting entries. We're going to have one, which is going to be interest expense, and the other is going to be depreciation expense on the right of use asset. So our entry for interest expense is always debit interest expense and credit lease liability. Okay, and normally we would pick up the number right from our schedule here. So we would be recording this number and this number, ignoring the rounding there. Let's get rid of our decimals in this schedule. Okay, so now what is the problem with this entry? Well, remember this lease was only signed on July 1st, 2020. So that means between July 1st and December 31st, we've only got July, August, September, October, November, December, 6 months. So this can only be 6 of 12 months. So this is going to be, what this is going to do is we're going to need to adjust these amounts to say, yes, that's the right amount, but now we're only going to record 6 out of 12 months. And same thing here. And so that's going to be the amount of interest expense we're going to record. The second entry is depreciation expense. So our entry is always debit depreciation expense. Credit accumulated depreciation. Depreciation, right of use asset. And what we're going to pick up here is going to be the amount of the asset divided by the term of the lease. And actually something interesting here is that this lease, the term of this lease, remember, is 5 years, but the economic life of this equipment is 10 years. Now, what is going to be our amortization period? Normally, we would use the term of the lease, but remember in this question, as the lessee, we think it's likely that we're going to take over the ownership of this equipment at the end of the lease. There's a bargain purchase option that's expected to be exercised. So we are going to amortize this lease, the equipment, over 10 years, not over 5 years, because 10 years is the economic life of the equipment. Okay, so that's the amount that we would record, but we still only have 6 of 12 months. So so we're going to have this amount is going to be the right amount times 6 over 12. And so we're only going to have 4,400 because we've only got those 6 months. So this is where you really need to watch the period. So because the dates of our lease is on July 1st, but we have a December 31st fiscal year, we have to split our entries, which is definitely something that we need to watch for. It's convenient when the leases are signed on January 1st and we have a December 31st year end. It's perfect. We don't need to make these adjustments, but because this is a July lease and we have a December 31st year end, we have to be careful on the periods. Now we're going to have the July 1st, 2021 lease payment. So we're going to have a debit, lease liability, credit cash, forgive my spelling here. And this is going to be for the entire lease. So we're going to have 20,066.26, a regular lease payment. And then we're also going to need to record the remaining 6 months of interest expense on the lease liability. So we're going to have debit interest expense, credit lease liability, and this is going to be from our schedule. This is actually going to be the same number that we used here. It's going to be the remaining 6 months because we need to get back to that same number. So we're still going to have this 3057 running here. Oops, let's just put this in 3057. Okay, I'm just going to round this. So you can see now that if I sum up my lease liability change between here and here, we've got back to that 6114, which is the amount we were expecting in our interest expense schedule. So we just had to stratify this between the 2 years. For depreciation expense, we're just going to wait to adjust that at the end of the year. So for December 31st, 2021, we're going to record our interest expense, another 6 months. So we're going to have debit interest expense, credit lease liability, and this is going to be the next number in our table. So now we're here, but we're going to use only 6/12. Same thing, 2429. I'm just doing this to round it, 2429. Okay, and then we're going to have our depreciation expense. Because we already recorded that half year, we'll just record the depreciation expense at the end of the year, which is going to be debit depreciation expense, credit accumulated depreciation right of use asset. And this is going to be 88,000 divided by 10. So this is going to be the full amount of this because we didn't record this in July. Now, why did we record the interest expense between the 6 months and the 6 months for 2021, yet we only recorded depreciation expense once? To be honest, I'm not entirely sure what the logic is of that, but we want to keep the interest expense correct because this runs through our lease amortization schedule. So we definitely need these numbers to be correct. The depreciation, we don't have a schedule for this that we need to keep to. So arguably it's more of a year-end adjusting entry. So it's okay to wait until the end of the year to record it, but it wouldn't have been wrong if you had recorded the 6 months at July and then another 6 months at December. That also would have been equally accurate. All right, let's scroll up. I think that takes us through to the end of this question.